afternoon and welcome to Biztech's Asian Midday Market Watch. It's the 13th of December, time's flying, and we have Glenn Yin, Head of Research and Analysis at AETOS Capital, coming to us out of Sydney. Now, Glenn, great to have you on the show again.
Thank you for having me again, Brian.
Now, Glenn, before we get your insights, we're going to take a look and see how numbers look like across the region. We're going to start with Singapore. The Straits Times Index is down 0.06%. Then we have Bursa Malaysia, the KLCI, is down 0.02%. Shanghai is down 0.53%. But the ASX All Ordinaries is in positive territory. It's up 0.32%. The Nikkei is up 0.3%. The Hang Seng is down 0.91%. The Kospi rounds up the numbers. It's down 0.66%. Glenn, it's a mixed bag today. Tell us why.
Yes, lucky to see this, Brian. The last two shows we had the seas of red, so it's
Yes.
something good for a change. I think we have seen one of the major key drivers I'm seeing right now is the incredible sell-off in crude oil in recent months. In fact, both the West Texas Intermediate and the Brent crude have dropped to their 5-month lows, and it's certainly creating headwinds for the ASX. The XEJ, or the energy sector sub-index, is down by nearly 1%, while the broader index, like you said, is up by about 0.3%. Now, I think the reason why oil has fallen off the cliff can be explained using a simple economic concept, that is demand and supply. On the demand side, markets are skeptical about the soft landing of the US economy, and at the same time, concerned that the Chinese economy will remain sluggish next year. So big question marks on these two biggest oil consumers in the world. On the supply side, despite OPEC Plus's extension on its production cuts, the United States, on the other hand, as the biggest oil producer in the world, are pumping out a lot more oil to flood the market, so that more than offsets OPEC's cuts, creating a foreseeable oversupply situation, and hence the crash in oil prices we're seeing right now. And this is expected to worsen in 2024 when the boosted production from the US actually start to hit the shelves, Brian.
And this is also interesting because it's not just the projected inventories in the US. So stockpiling it's at record levels, I think over 9 million barrels. So, as you said, it all sets the tone for lower oil prices starting in 2024.
Exactly, Brian.
Now, looking across then, oil, of course, fuels inflation. US CPI numbers came in at a slower number to 3.1 on an annualized basis for November. That was in line with expectations. Obviously, markets have reacted very positive to that. Glenn, give us your insights into that and how you see that playing out.
Yes, Ryan. So the crash in oil price, or not so much in the crash in the previous month, but the deceleration and the drop in the oil price certainly played a key role in bringing that inflation on par with the market expectation. We saw that data coming out earlier this morning, pretty much in line with expectation, with a tiny uptick in monthly inflation. So U.S. equity bulls somehow still managed to find positivity in the data, like you said, and push the 3 benchmark indices to fresh 2023 highs. Brian, I think we should bear in mind that both the Nasdaq and S&P 500 are now within striking distance to their respective historical highs. So very exciting moments indeed, but this will once again be challenged by the upcoming Fed interest rate decision, which is also due tomorrow morning.
Okay, so what are we looking out for? It's the last FOMC meeting. What is expected from Powell's rhetoric? Higher for longer, or markets are pricing in perhaps an earlier cut than expected?
I think now there's this basically universal agreement that the Fed will hold on to the current rate in its last FOMC this year. It's basically ignoring Jerome Powell and saying, hey, we're not afraid of you anymore because you have no more bullets in your gun. Whether this Fed roulette will end well or not, we'll find out soon enough. But Brian, for this particular meeting, I'm more interested to see the Fed's economic projection package and the dot plots, which will be released alongside with the decision, and how the Fed members themselves are projecting the interest rate in 2024. Just as a quick comparison, CME's data shows that markets have certainly lost their mind to pricing as much as 100 BP cuts by June 2024. So that aggression will face yet another reality check tomorrow, and how markets interpret the projections will probably be the last major market mover of 2023.
Now, Glenn, on a different note, through your Australian lens, we had a RBA that basically kept rates unchanged in our last show, which basically brought Christmas cheer to borrowers in Australia, particularly homeowners. What are you seeing in the Australian market for the rest of the year?
I'm thinking from the market's perspective, Brian, I think we are very much going to follow the US equity markets as usual, but I'm seeing a little bit more tailwind, hopefully. Pretty sure that center rally has already arrived, so the positivity and the momentum are all there. And on the human level, we must also remember that it's human beings and households, Australian people we're talking about here. On the economic side, there's the monetary policy debates, and on the human level, the families are making their festive season count. So yes, spending will be up a little bit. Inflation may jump up a little bit more next year, but I think things are all set. The heavy front loading is definitely done.
On that note, Glenn, thank you very much for your insights. Thanks for coming on the show.
Thank you, Brian.
Now, we've been speaking with Glenn Yin, Head of Research and Analysis at AETOS Capital Group, coming to us out of Australia. This has been Biztech's Asian Midday Market Watch. I'm Brian Fernandez. Check out the show on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites.